Up until mid-1997, Indonesia was widely viewed as a model of economic development. High domestic investment fueled a long, continuous period of growth, and international observers consistently praised the developing nation's macroeconomic stability. Looking at these macroeconomic indicators from a Bank Indonesia report, we can see why. Gross domestic product, the total value of goods and services produced, grew by 8.2% in 1995 and 8.0% in 1996. By standard metrics, this was a highly robust economy. Yet in less than 12 months, this narrative completely unraveled. A country celebrated for stable growth plummeted into total financial insolvency. To understand the sheer scale of the collapse, look at these two metrics. In July 1997, the exchange rate stood at a comfortable 2,374 rupiah to the US dollar. By early 1998, it plunged past 10,000 to the dollar. Simultaneously, interbank interest rates, the cost for banks to borrow from each other, spiked to an astonishing 350% by January 1998. While a wave of regional financial panic acted as the immediate trigger, the severity of Indonesia's collapse was actually the result of a fatal macro-micro mismatch. The stable macroeconomic facade of the so-called Asian tiger disguised a highly fragile microeconomic foundation, one built entirely on unhedged short-term foreign debt and severely compromised private banks. The timeline of the crisis begins in July 1997 in Thailand. The Thai government devalued the baht, serving as the initial catalyst for regional panic. Foreign investors exhibited what analysts call a block mentality. Treating Southeast Asian economies as essentially identical risk profiles, they initiated a massive and simultaneous reversal of capital flows out of the region. In response to the sudden selling pressure, Bank Indonesia initially attempted to defend its currency. They widened the rupiah's intervention band from 8 to 12%, hoping to absorb the shock. By August 14, 1997, the capital outflows became insurmountable. Bank Indonesia was forced to abandon the peg entirely and let the rupiah float freely against the market, leading to an immediate and sharp depreciation. The initial trigger was undeniably external. However, the decision to float revealed that the rupiah's previous value was no longer sustainable once market sentiment shifted. The real danger lay buried in the balance sheets of the Indonesian private sector. Prompted by high domestic interest rates, corporations had looked outward for financing, accumulating $140 billion in foreign debt by June 1997. The structure of this debt was highly volatile. $33 billion of it was short-term debt, meaning it matured quickly and could no longer be easily rolled over or refinanced in a panicked market. This balance sheet highlights the core flaw. The debt was unhedged. Corporations earned rupiah, but owed US dollars. As the rupiah depreciated, the mechanical impact was devastating. The cost of repaying that US dollar debt exploded geometrically, while rupiah revenues remained completely static. This triggered a currency mismatch death spiral. Panicked corporations rushed the forward market, desperately trying to buy dollars to cover their maturing debts. This intense demand for dollars drove the value of the rupiah even lower, which in turn increased the cost of their remaining debt, a self-reinforcing loop of insolvency. Financial panic was compounded by physical crises. A severe El Niño drought and widespread forest fires choked the region, exacerbating economic misery and deepening domestic uncertainty. International rating agencies responded to the deteriorating conditions. Standard & Poor's and Moody's downgraded Indonesia's sovereign rating to non-investment status, which accelerated the flight of foreign capital. By October 1997, the situation was dire enough that Indonesia signed its first stabilization program with the International Monetary Fund, but the IMF intervention failed to restore confidence. The market lacked complete information on the true massive scale of private corporate debt, and there was stiff domestic resistance to the required structural reforms. What began as a regional currency shock had mutated. The unhedged debt spiral turned the initial devaluation into a pervasive corporate insolvency crisis that paralyzed the entire domestic economy. As corporations defaulted en masse, the damage shifted immediately to the banking sector. The volume of non-performing loans, debts that borrowers have stopped paying, surged to approximately 27%. This exposed a systemic lack of prudential supervision. The central bank was entirely unable to keep pace with the rapid expansion, deregulation, and increasing complexity of private bank operations. To understand how internal governance failed at the micro level, we can examine Bank Umum Nasional, or BUN. Founded in 1952 by prominent political figures, the bank was eventually taken over by two highly influential businessmen, Kaharudin Onko and Bob Hassan. Under their control, BUN operated under a cash cow, or sapi pera, dynamic. The bank functioned primarily as a vehicle to gather deposits and fund the owner's own vast, risky conglomerate activities. When the 1997 liquidity crisis hit, public confidence in the banking system collapsed. Interbank lending froze completely, and depositors rushed to make massive withdrawals. Terrified of a domino effect, Bank Indonesia provided massive emergency loans called BLBI. For Bank Umum Nasional, the injection reached 12.06 trillion rupiah. Yet the owners misallocated this capital, channeling the central bank's money out the back door to service their own failing corporate conglomerates. The rot was too deep. On August 21, 1998, the government officially froze Bank Umum Nasional, stripping its operational status and ending its long history. BUN was not an isolated case. Widespread corporate mismanagement and the abuse of private banks as captive financing vehicles turned what could have been a manageable liquidity shortage into a total systemic collapse. The final toll of the crisis was catastrophic. Decades of steady economic progress were reversed, inflation hit record highs, and millions of Indonesians were dragged back below the poverty line. The events of 1997 and 1998 offer a stark mechanical lesson. External capital flight provided the initial spark, but internal structural debt and poor corporate governance supplied the fuel for a full-scale collapse. Private banks, operating without stringent supervision or independent management, failed to act as economic shock absorbers. Instead, they became primary vectors of systemic risk. Capital market stability cannot be sustained by macro indicators alone. If micro-level credit, corporate governance, and banking fundamentals are structurally compromised, impressive macroeconomic growth remains a fragile illusion, vulnerable to sudden and catastrophic shocks.